Full speed ahead. $1.9 trillion, 100 million vaccinations, and strong new projections for growth. But is there a speed limit to how fast we can drive this economy? This is Bloomberg Wall Street Week, this week devoted to the I word, that is inflation. I'm David Westin. This week, contributors Larry Summers of Harvard.
Seems to me that what was kindling is now igniting.
And Bloomberg's Stephanie Flanders. Brian Moynihan of Bank of America. Ray Dalio of Bridgewater.
You're going to probably see higher interest rates because growth will be stronger, inflation will be stronger.
Paul Krugman of the City University of New York.
This is definitely significant stimulus, but not wildly inflationary stimulus.
And Dan Tarullo of Harvard. This was the week it all came together. The $1.9 trillion infusion of cash into the economy started to hit bank accounts, with more than half of the $400 billion destined for individual Americans already deposited. Vaccination rates picked up, marching toward 3 million a day in the United States, for a total of more than 100 million so far. So it's not surprising that the Fed took up, and I mean way up, its growth projections for the U.S. economy, from 4.2% GDP growth in 2021 to 6.5%, and took down its unemployment estimate all the way down to 3.9% by the end of the year, and going down even further to 3.5% next year. Taking up the growth in employment estimates isn't all that surprising, but what might be surprising is what it meant for the Fed's inflation estimates. It meant nothing, as it sees headline inflation reaching all the way up to 2.4% this year and then settling right back down to 2%.
We will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time.
And equity markets, well, equity markets more or less basked in all the good news. Treasuries, though, had a tougher time, as the yield on the 10-year continued its upward climb this week, maybe raising at least an eyebrow at how sanguine the Fed seems to be. So where does this all lead? Do yields continue to climb? At what point does the Fed need to step in? And if it does, where does that leave the dollar? When it comes to understanding the intricate mechanism that is our financial system, there is no one like Ray Dalio, founder of Bridgewater Associates. Ray is clear that he's not saying what the U.S. should do. Indeed, he's written a book on how capitalism needs to be reformed. But Ray has a clear and certain view about the consequences of fiscal and monetary policy, whatever those policies may be. So we turn to him this week to get a sense of where we may be headed.
What we've seen this go around is the need to distribute, to produce a lot of debt. Where did those checks come from? They came from the government. The government wrote the checks, but the government can't produce money. The central bank can produce money. So the central bank had to print a lot of money to lend to the government to do that. And that's monetization. When you get at the late part of that cycle, where you're creating a lot more debt and then you're monetizing it, that's the end of that's near the end of a long-term debt cycle. And that produces its own set of problems.
So what tells us when we're nearing the end of that cycle? I mean, just in recent days, including this week, we've seen the 10-year yield really shoot up. It's still at a modest number historically, but it certainly shot up very quickly. Is it an early warning sign that maybe we've pushed it a bit far on the stimulus side? Because goodness knows we've had a lot of stimulus.
Yes, I think let's understand what's behind that. And then you can understand what the warning signs are, because it's just a manifestation. When there has to be a lot of selling of bonds, and bonds don't give any good return, there's a guaranteed negative return in bonds relative to inflation. Inflation index bonds yield minus 1%. And so there's no return. And there's a pile of people who own bonds. And this isn't just Americans, but these are international investors owning bonds. And they have to buy a lot more bonds because when the government has to sell a lot more debt, that means they have to buy a lot more bonds. There will not be enough demand for those bonds. When that happens, interest rates rise. That's what you're seeing now. And the central bank is put in a dilemma. This is all classic end of cycle type of thing. The central bank is put into a dilemma because either interest rates will rise a lot, or they will have to print money and buy those bonds to hold them down. When they print money and buy those bonds to hold rate down, that lowers real rates and it accelerates a depreciation of the value of the dollar. And it also raises inflation pressures. And what the imbalance, the frightening thing about this, is that if you get losing money, and people are losing money by holding bonds, and that's not just Americans, those are other foreigners, then they could sell bonds. And if they sell bonds at the same time as the government has got to sell a lot of bonds, that could produce a real dilemma. That's classic late long-term debt cycle type stuff.
So let's talk about Jay Powell's dilemma right now. You describe it as a dilemma. He appeared this week and basically took a hard look at the debt market, at the Treasury market, looked in the eye and said, I'm not going to do anything to help you. And they didn't like it very much. And so the 10-year kept going. At what point is there enough pain? And what form does that pain take? Is it really financial conditions tightening? I mean, does it have to get to be 2.5, 3, 3.5, 4?
Well, as I said, think of the economy as being like an individual and their pulse is dropping. When the pulse is dropping, the doctors come running in with the stimulant and they inject stimulant. Now that the economy is rebounding, and inflation pressures are rebounding, there's not the same pressure to administer that stimulation. When it happens, when it becomes a problem, is first, the rising interest rates start hurting financial asset prices. First, typically, they hurt bonds. Then they pass through and hurt stocks, because still interest rates affect stocks. And when that starts to affect stocks, that's one thing. Maybe the stock market can correct 10 or 15%, and the Federal Reserve can tolerate it. When it goes beyond that and starts to affect the economy, that's when you see the real trade-off have to surface. So that's what that looks like.
Okay, so let's play a little Dickens here and ask about the ghost of Christmas future. At the very end, they say, is this what has to be, or can I still change it somewhat? Can we change it somewhat? And could Jay Powell specifically change it, or for that matter, the administrative government?
It's not an easy thing to change, because what do? Spend less money? And if you spend less money, you give less checks out? Or you can't get people to easily earn more money and change that. So it's a difficult dilemma, and it's a particularly difficult dilemma that I think that you're going to see, particularly the late this year and beyond that, because late this year, you're probably going to see everything be a problem. You're going to probably see higher interest rates because growth will be stronger, inflation will be stronger, and that you'll see probably there won't be enough demand on it. So the thing to watch out for as a signal, if this happens, is that you see the need to buy bonds when the economy is strong and when inflation. If you take, there's this year and then there's beyond this year. There's the next few years. It's a problem, because how we're going to spend money is a political issue, a big political issue. And we're going to have to, and there's going to be too much spending. And so that'll affect the value of the dollar and or interest rates.
Ray, as we speak, the Federal Reserve is buying something like $120 billion, both in treasuries and mortgage bonds right now. How can you justify that when they came out and said we're going to have 6.5% GDP growth this year?
The Federal Reserve would say we're just going above their inflation targets, not by much. If you look at indicators like the break-even inflation rate, it's about 2.5%, and they would say not yet. But the important thing to convey here on inflation is that there are two types of inflation, okay? I just want to make this clear. We're used to one type of inflation, which is when the economy is too hot, there's a capacity constraint, and when demand presses up against existing capacity, prices rise. Unemployment rates are low and so forth. There is a thing called a monetary inflation. That's when you can have stagflation. And that monetary inflation means that even when the economy weakens, inflation rates rise because there's too much inflation and there's the move out of that. So you're seeing the move out of bonds and cash to move into other assets like stocks and other investment assets, to some extent stocks, gold, other currencies, Bitcoin, and the like. But you can start to see a monetary inflation. The real risk, the big risk, is of a monetary inflation, which would come because there would be more sellers of bonds than there are buyers, and the need for a lot of printing of money.
So Ray, you're recognized as one of the great investors of our age. So give us some investment advice here. Given what your analysis of how this works, what's going to happen, given what we're doing right now, what's the best investment? We heard Jamie Dimon just recently say he wouldn't touch a 10-year Treasury bond with a 10-foot pole.
Well, I wouldn't touch a 10-year Treasury pole, with a 10-year pole either. Cash is trash. In other words, it looks like a low risk thing to hold, but it's not, because when you have a zero interest rate, or in some cases in foreign countries, slightly negative interest rate, and you have an inflation rate of 2% or higher, you get taxed at a rate, essentially you lose buying power at a rate of about 2% a year, and that's a lot. You lose a lot of buying power. And so this is one of those environments you don't want to hold cash. If anything, maybe you borrow some cash and find something that has better than a zero interest rate in it, or something that has inflation. If you bought the average thing, which is inflating at 2% or more a year, you'd be better off. However, so then the other thing you need to do is diversify well. Okay, so don't have cash, and then you need diversification, and the diversification should be currency diversification, country diversification, as well as asset class diversification.
Thanks to Ray Dalio, co-chairman and co-CIO of Bridgewater Associates. Coming up, what $1.9 trillion and vaccinations mean for the real economy. We hear from Brian Moynihan, chairman and CEO of Bank of America, about what all this growth means for his customers and the prospect of inflation.
Credit card charges, which had been depressed because it's a lot of travel and entertainment, are back and actually growing year over year.
This is Wall Street Week on Bloomberg. This is a special edition of Wall Street Week. I'm David Westin. Everybody pretty much agrees that the vaccines going into people's arms and the $1.9 trillion going into the economy are going to trigger remarkable growth this year. The question is how much, and how we can handle that much growth without triggering inflation, which is what we asked Bank of America Chairman and CEO Brian Moynihan.
Our team has the U.S. growth predicted. Candace Browning-Platt, the #1 research platform for many of the last decade and years since I've been CEO. They do a terrific job. They have the U.S. growing at 6.5% for 21 and around 5.5% for 22. Now, you have to step back and think about that. That's an economy basically the same size it was coming into the middle to the end of 18, which was pretty good times in the U.S., predicted to go at 3 times the rate with an interest rate environment that is probably half or lower than it was then. There's all the angst about the 10-year moving to 160, but at that point it was 2.5 moving towards 3. Think about, and the Fed funds rate was much higher than it is now. So think about the amount of accommodation, and then you add the $1.9 trillion stimulus on top of it, plus the stimulus that's still unspent. So when you put that all together, and then the stimulus, frankly, from people going back to work as the economy reopens, the team is at 6.5% in a huge economy. In the U.S., growing faster than the world economy is predicted. They got 5 for the world. If you think about that, that is a pretty powerful engine that has already recovered about 95 to 97% of where it was, and now is growing at 3 times the rate. That's a pretty powerful prediction, and our team is quite convinced it's all there.
Well, and that raises the question a lot of people are asking is it possible we may be overheating the economy? Because we also have been increasing the money supply. I think it's up something like 25% year over year, the M2. It's been held down, the inflation, because there hasn't been much velocity because people are at home. What happens when they come out of home? In fact, some of those depositors you talked about that didn't spend all their stimulus checks, they have it sitting there in their bank account. Are you worried we could get inflation that would be troubling?
Well, that's part of the discussion you see in the market. But let me just tell you what we're seeing in our customer base, David, that will help you think about that. If you think about last year up till March 9th or 10th, that was before any activities had taken to shut down. And we were all hearing about this virus and learning about it. It was really the March 15th and out where people started taking, at the government level and the employee level, significant actions. If you look at that period of time, 2020 over 19 grew, double digits, say 10%. When you look at it, 20 to 21, we're now growing at 6%. And if you look at it for the month of March, for the first part of March here, it's actually growing above 10%. That's pretty unbelievable. And what you're frankly seeing now is the credit card charges, which had been depressed because it's a lot of travel and entertainment, are back and actually growing year over year. Growing year over year at a time pre-pandemic shutdown. And so you're going to see massive year-over-year comparisons as you move into April when everything was shut down. So the reality is the consumers at Bank of America, which is 50 million people spending $3 trillion plus a year in all these different forms, are spending more money than they did last year and growing at 10%. And that was before the pandemic. That bodes well. And then if you look at the charges, you can see like on a credit card, the seniors and boomers are getting vaccinated. We're up 50% in charges over the last few weeks in terms of travel and related things. You're seeing the TSA statistics. So the types of things are happening. Now, by the way, grocery stores are down a little bit. Why? Because people shifted more to restaurants. And that's all bodes well for normalization of the economy. So we see that very good. Does that overheat the economy? I think you've heard it from Chair Powell in many cases. They're willing to take the risk to get the average inflation rate above 2%. There are people concerned in the market. We all have that concern because inflation's tough to fight if it gets embedded in there.
Thanks to Brian Moynihan, Chairman and CEO of Bank of America. Coming up, it's not just the United States that's giving unprecedented monetary and fiscal support to its economy. Contributor Stephanie Flanders of Bloomberg Economics takes us through the global picture.
The economy is like a coiled spring, and that as it bursts forth, there may be more inflation coming than the Bank of England's expecting.
This is Wall Street Week on Bloomberg. This is a special edition of Wall Street Week. I'm David Westin. The world economy has needed a lot of help because of this pandemic. And at least in the developed world, it has gotten a lot of that help. We asked Wall Street Week contributor Stephanie Flanders, senior executive editor of economics at Bloomberg, whether we're seeing concerns about possible inflation raised outside of the United States.
There has been, I think, a lively debate sort of behind the scenes in the corridors of the Bank of England, to the extent that anybody walks along corridors anymore, about whether or not there was going to be a serious sort of inflation issue coming out of what we expect to be a pretty strong rebound in the UK economy as it completely, in theory, reopens in the summer. The chief economist, Andy Haldane, has said the economy is like a coiled spring, and that as it bursts forth, there may be more inflation coming than the Bank of England's expecting. But that isn't really filtering through to any change in the policy outlook or even a discussion of that at the moment, because there is a feeling that to the extent that bond yields are going up, the market's kind of conditioning, tightening of its own accord. The Bank of England's not pushing back on that, but nor does it want to get a reputation for being hawkish and somehow be too distinctive relative to other central banks.
I wonder, Stephanie, if there's a subtle difference between the way the Bank of England is approaching this and the way that Jay Powell at the Federal Reserve is, because Jay Powell is very willing to say we're not even thinking about doing it. So the optionality doesn't seem to be there right now, saying basically we're going to give up the option of raising for the time being. Is the Bank of England a little bit more on the fence, saying if we need to go that way, we can?
Yeah, I think that's fair, and I guess I think we probably think Jay Powell is the one who's out there in the, you know, maybe the most dovish dove out there, at least at the moment. But he also has some things that he can point to in the US in terms of labor market slack and the still relatively low participation rate that we don't frankly have in the UK. We came into this with a very high participation rate, none of the issues that we've seen on that in the US, and we've managed to keep unemployment pretty low thanks to that big government furlough scheme. So I think there are reasons why the UK wouldn't feel that it could be completely out there in ruling out the option of tightening, because we maybe do have a few more bottlenecks and less slack in the labour market.
So, Stephanie, let's go across the channel, if we could, to Brussels, because we seem to have a bit of a different message coming out, particularly of Christine Lagarde, the president of the European Central Bank, really now urging that people get on with it when it comes to fiscal stimulus. I know that there have been arrangements made to have it happen. She seems a bit impatient.
Yes, and I think there's a couple of things going on here. So as you know, the European Central Bank, it has been trying to push against that increase in yields, doesn't think it's justified by the state of the European recovery. That's different from the UK and the US, where it is domestic strength that's helping to push up yields and central banks are more relaxed. At the same time, some concern about whether the great reopening and recovery that they're hoping for in the Eurozone will be able to happen if you continue to have this very weak rollout of vaccines compared to the UK. The combination of that leaves her really wanting to make sure the stimulus is coming down the track. That historic 750 billion euro recovery plan, where the Europeans came together amazingly last year, it hasn't got out the door yet.
Thanks to Wall Street Week contributor Stephanie Flanders. And now it's time to take a look at the week ahead on Global Wall Street.
David, more central banks on tap next week in Asia, with rate decisions due from Thailand and the Philippines. Both are seen standing pat. Inflation in the Philippines has picked up above the BSP's target, but policymakers are likely to keep looking through supply-side pressures, which the governor said are transitory. And on the earnings calendar, Tencent's report card may be overshadowed by regulatory risks, as Asia's largest conglomerate may be the next target for tighter supervision after the clampdown on Ant Group. And another Chinese tech heavyweight will be in the spotlight. Baidu will be making its trading debut here in Hong Kong on March 23rd after raising $3.1 billion in its secondary listing. Danny?
Thanks, Sophie. This coming week in Europe, we have the EU Leaders Summit taking place in Brussels starting on Thursday, where the focus is likely to be the chaotic rollout of the vaccine, which surely will have an impact on the reopening of the economy. We'll also get more clues on the economy and the growth we're likely to see with flash PMIs for the region due out. Romaine?
Thank you, Danny. Fed Chair Jay Powell and Treasury Secretary Janet Yellen making a joint appearance before Congress next week. They'll be testifying on the policies their departments use to ease the economic fallout from the COVID crisis. And that appearance comes the same week as the one-year anniversary of the pandemic-related stock market crash. It was a 23-day, 30% plus tumble that marked the fastest ever descent into a U.S. bear market. Also on Capitol Hill next week, the CEOs from Facebook, Google, and Twitter, all three facing questions from lawmakers about how their social media platforms handle misinformation. As for economic data, investors will be looking at metrics on existing and new home sales on Monday and on Tuesday, orders for durable goods on Wednesday, and on Friday, the latest monthly personal income and spending report. David?
Thanks to Sophie, Danny, and Romaine. Coming up, the great Krugman-Summers debate over the risk of inflation. We hear the dovish side from Nobel Laureate Paul Krugman.
Inflation expectations, it took a long time for them to get unanchored in the past.
This is Wall Street Week on Bloomberg. This is a special edition of Wall Street Week. I'm David Westin. The question of what the $1.9 trillion fiscal injection will mean for the U.S. economy has generated something of a debate between two of our most respected economists, former Treasury Secretary Larry Summers of Harvard and Nobel Laureate Paul Krugman. Each recognizes that the other has a point, but they have a decided difference in emphasis. With Larry concerned, we're underestimating the risk of inflation, and Paul saying it's not as big a risk as Larry suggests. So we went to the sources themselves and first asked Paul whether in part the problem is that we are very much in uncharted territory.
It's very hard to come up with a historical parallel. Actually, one of the funny things I just want to say about the debate between me and Larry is that we conceptually have very similar views of the economy. We're just making some different judgments about the numbers. It really, I don't think you can take a look at the way he's talking about it and the way I'm talking about it and say that there's a fundamental difference in economic philosophy there. It's really a judgment about the numbers. And I think that if I was going to make my case, I would look at the form of this $1.9 trillion and say that a lot of it is, in fact, although useful in important ways, is not going to be pushing up demand all that much in the short run. A lot of those $1,400 checks are going to be saved. It looks like quite a lot of the state and local government aid is going to be used not right away to lead to a big increase. There'll be some restoration of employment, but some of it will probably end up in effect financing public investment that will take place over several years. So it's a question of the numbers, and for what it's worth, which may not be much, the consensus of Wall Street economists is closer to my view, which is that this is definitely significant stimulus, but not wildly inflationary stimulus.
When the Fed Chair, Jay Powell, has been asked about it, as well as Janet Yellen, now Treasury Secretary, they both have said, look, the Fed has tools it can use if, in fact, we start to see inflation getting away from us. Is the Fed positioned to use those tools? Because it's been sending very strong messages in the marketplace. It's not just that we're not thinking about some tightening on the monetary fund. We're not even thinking about thinking of it. Does that make it potentially more abrupt if they have to change their position?
They would be, certainly people at the Fed remember the 94, the bond market shock of 94, where somehow or other the market concluded that the Fed was really going to be a lot more contractionary than they had previously expected, and that shook people up. On the other hand, the Fed is aware that nothing really terrible happened as a result of that bond market shock. And so the Fed is definitely, no one at the Fed wants to be the people responsible for bringing back the 1970s. So I don't think there's that much constraint. And of course, this always comes back to this fundamental asymmetry. When interest rates are at zero, if fiscal policy falls short, then the Fed has a very hard time making up for that. If fiscal policy overshoots, the Fed has mechanically, they have very easy tools to use to bring it in. So now we're just into the question of some kind of mind reading. Do we think that the Fed is going to be afraid to do what's necessary should this turn out to be a really huge boom? And I don't, these are smart, tough people at the Fed. One of the institutions in American life that has really held up pretty well in all of the other chaos that we've been going through. And I'm not particularly worried that they will fall short on this front.
When you're reading minds, I think some of the minds we have to read are consumers, essentially. Right. That is, in terms of inflation expectations. You referred to the 60s and 70s when inflation clearly got away from us. And we know what had to happen there when Paul Volcker came in and really clamped down. We had, I think, 2 recessions as a result. What is the risk of inflation expectations becoming unanchored? That is to say, it starts to go too fast, and even though the Fed wants to act, the attitudes of the people are, we think inflation's coming.
Well, for what it's worth, and again, this is these are new. We're in many ways in unprecedented territory, but inflation expectations, it took a long time for them to get unanchored in the past. It took not just excessively expansionary policy under Lyndon Johnson. It took 2 oil shocks that sent inflation temporarily into double digits. It took seriously irresponsible monetary policy under Arthur Burns. It took a long time to get us to where we were in 1980. It took really more than a decade of screwing things up year after year to get to that pass. And I don't think we're going to do that again. You know, the capacity, anyone who thinks that we've got a foolproof system is underestimating the fools, but I don't think we're in anything like that situation. It was not the case that one day people suddenly woke up and said, oh my God, inflation is unhinged. I'm going to start expecting 10% inflation. That's not how it worked last time, and it's not how it's going to work this time.
So I'm going to ask you to do something I think difficult. Play for the other team. Put the red jersey on instead of the blue jersey right now, and assume you're wrong. Let's assume you're wrong and inflation does get ahead of us. Look back on that era and tell us why you would have been wrong. What's the thing that worries you the most about the analysis?
Oh, I think the biggest concern simply is, well, this is one heck of a lot of money. This is an awesomely gigantic fiscal package. I mean, this has really caught everyone by surprise. I mean, I talk a lot to people, particularly people on Wall Street whose business it is to try to forecast policy, and everyone assumed that this was going to come in below, that the 1.9 trillion was an opening bid, and that the real package would be a lot closer to 1 trillion. And instead, we got the whole thing. And it will certainly be possible that this will be an episode that will look like, it will look like the Burns overshoot in 72, or will look like Edward Heath's Go for Growth in the early 70s in Britain, that it'll be a time when we went ahead of ourselves. But I would say that the concerns there are mostly not about the economics, because I'm fairly confident that with responsible Fed policy, inflation is not going to get out of control. But maybe I'm misjudging the Fed. Maybe the Fed is intimidated. Maybe we are. The concern always on these things is, are we fighting the last war?
It's always dangerous to project history in advance, because who knows how it'll look. But I'm curious about your thought on one thing. I've seen it suggested that perhaps what we're seeing here is more than just a response to an historic pandemic, something we haven't seen before, but perhaps a fundamental turn in economic regulation in the United States, something on the order of when Ronald Reagan came in 1980, a new era being introduced. You mentioned redistribution in the American Rescue Plan. Do you think history may judge this as a fundamental turn more than just a reaction to a pandemic?
Well, yeah. I mean, what's notable is not just that the bill is big and that we're doing a lot of stuff, but the whole discussion has been just the language of this is just bearing no resemblance to the past. We're barely hearing people worrying about making life too easy for the poor so that they won't work. Not a lot of the whole rhetoric that dominated American discourse for 40 years seems to have just vanished. I mean, it's amazing how conservatives, we're just not hearing the kinds of arguments that they were making, or barely hearing them.
That was Paul Krugman, author of Arguing with Zombies. Coming up, we'll hear the other side of the debate from our special contributor, Larry Summers of Harvard.
I think we are running enormous risks.
This is Wall Street Week on Bloomberg.
I don't think the right question is whether this package would overheat the economy. I think if it were passed as written, it would overheat the economy.
That was special contributor Larry Summers here on Wall Street Week back in January. Now, 2 months later, the question is what has changed and whether the risk of inflation is less or more than what Larry saw back then.
David, I'm much more concerned. Markets have had their biggest increase in the 10-year in a century, with only one exception, showing that they've got a real concern. The fiscal policy outlook has dimmed from where it was as the full stimulus that was contemplated then has passed. People have declared that it's a new era in ways that suggest that large fiscal policy will continue for a long time to come. The COVID recovery has accelerated, which is a very good thing. but means more demand pressure. And the Fed has stuck to its guns on no rate hikes for years and years and continuing to grow its balance sheet. So it seems to me that what was kindling is now igniting. And I am much more worried that we'll have either inflation or we will have a pretty dramatic fiscal monetary collision.
Are we mishandling macroeconomic policy right now in the United States?
I think this is the least responsible macroeconomic policies we've had in the last 40 years. I think fundamentally it's driven by intransigence on the Democratic left and intransigence and completely unreasonable behavior in the whole of the Republican Party that's driven us to the kind of political deals that we're seeing, and they're understandable. And I understand why reasonable people, given the tragic choices they have, might make these kinds of macroeconomic choices. But I think we are running enormous risks. I would put the risks this way, David. I think there's about a 1/3 chance that inflation will significantly accelerate over the next several years and will be in a stagflationary situation, like the one that materialized between 1966 and 1969, where inflation went from the range of ones to the range of sixes. I think there's a 1/3 chance that we won't see inflation, but that the reason we won't see it is that the Fed hits the brakes hard, markets get very unstable, the economy skids downwards close to recession. And I think there's about a 1/3 chance that the Fed and the Treasury will get what they're hoping for, and we'll get rapid growth, which will moderate in a non-inflationary way. But there are more risks in this moment that macroeconomic policy itself will cause grave consequences than I can remember. There have been terribly serious moments in the past, but then macroeconomic policy was trying to stabilize things. Now there's the real risk that macroeconomic policy will be very much destabilizing things.
You and Paul Krugman have had an extended debate, a constructive debate, I would say. You agree on a fair amount of things, although you disagree around the edges. One of the things that Paul Krugman says is we don't have to worry about this inflation risk quite so much because it takes a long time. If you go back to the 70s, it took 10 years to really have it develop, and therefore there's plenty of time for the Fed to react. What's your response?
He's just wrong. Look at the 1966 to 1969 period, before there were any supply shocks, when William McChesney Martin was exuding much more concern about inflation than Jay Powell is today, when the guns and butter of Lyndon Johnson was a very small fiscal expansion compared to what we're seeing today, and when inflation went up about 4 percentage points in a three-plus year period. It's just wrong to say that. And this idea, I don't understand how people say that expectations are anchored. And they also say that we're in an entirely new era of policy where the neoliberal era is over and a new progressive tide is behind us. If we're in an entirely new era of policy, then I'd expect people to reorient their expectations. So I don't really understand the logic of those who are serene right now. And to remind, markets have had as dramatic a first quarter as any time in the last century, except for 1980, which was, of course, presaged all the chaos of the end of the Carter years and then the terrible 1982 recession.
Larry, you had the experience within the government as well as being in academia. And I'm curious about how you get responsible macroeconomic policy in a true democracy, because it is, I think the Romans called it bread and circus. And you saw that, I think, personally, in the $1,400 checks. Who can be against getting a $1,400 check? How do you have responsible macroeconomic policy when some of the things that are most popular might not be that responsible?
I think ultimately there's a very important responsibility for senior economic officials to be prepared to speak truth to politics, even if that truth is not welcomed. And I think over time, I'd expect that Janet Yellen and Jay Powell, both of whom I've got great respect for, will be prepared to do that. I've been very disappointed by many in the economics profession who feel like it's their job to judge the politics. And they think this is necessary politics for the new administration, and therefore they're going to make arguments for it economically. Well, it may be necessary politics, and it may be that it's the right choice. But I think the better place for economists to be, certainly economists out of government, is to be analyzing the economics, not trying to rationalize the politically convenient. So I've been rather disappointed in, frankly, Paul Krugman and many parts of our profession who have gravitated to the political side of this discussion. And again, they may well be completely right about the political side of the discussion, but who haven't assessed the economic risks.
Thanks to special contributor Larry Summers of Harvard. Coming up, have the unprecedented effects of the pandemic and the response gone beyond our economic models? With Dan Tarullo, former governor of the Federal Reserve.
We really don't have a workable theory of inflation that is useful for real-time policymaking purposes.
This is Wall Street Week on Bloomberg. This is a special edition of Wall Street Week. I'm David Westin. Whether the jolt coming for the U.S. economy leads to inflation or just to getting us back to where we started will depend in large part on the labor market and how many of the millions of Americans still unemployed because of the pandemic we can absorb before we see any surge in wages. Dan Tarullo of Harvard Law focused a good deal on the labor market during his tenure as a governor of the Federal Reserve.
The discussion here is probably going to be, to what degree is this really bounce back? I mean, we continue to have, obviously, higher unemployment. We continue to have people underemployed. We continue to have people who are working only part-time who would like to be full-time. So there's clearly additional slack in the economy. I don't think there's any question about that. I think at the Fed, what they're going to be asking themselves is, to what extent are developments over the course of the next quarter or two ones beyond what they would have anticipated, even with a pretty quick snapback? We've been saying, David, I've said it, you and I have talked about it on your shows for the last year or so. This was really an unprecedented kind of economic hit, which with the shutdown and its dramatic an impact on the real economy as it had. So I think we would all have anticipated or hoped for a pretty dramatic snap back as well. And then the question is, to what degree are you basically where you were in early 2020? To what degree are you in a fundamentally different situation?
Well, the unprecedented word there in that answer is what really strikes me, because unprecedented can make us nervous because we're not sure exactly if our GPS is working any longer. We've had different models. For example, you have on the one hand Paul Krugman saying, don't worry about inflation. This is not a typical downturn. On the other hand, you have Larry Summers talking about output gaps. And then Paul Krugman comes back and says output gap isn't relevant. How do we know which model to follow or whether there is a model?
Well, I mean, I've thought for some time, going back to my time in the Fed, that we really don't have a workable theory of inflation that is useful for real-time policymaking purposes. And that's obviously more than a little disconcerting for monetary policy makers. That the rational expectations model was dispensed with some time ago. The Phillips curve output approaches, which are driven really quite literally by economic modeling, don't seem to have performed very well for the last couple of decades. People hang on the notion that inflation expectations is what the most important variable and factor. But even if that's true, we don't have a particularly good sense of how the public's inflation expectations change, when they change, when those expectations become unanchored. So I would say, I mean, I having watched Paul Krugman and read some of the things he's written, I think he's careful to say that people identifying a risk, some risks here, are not being unreasonable. But I think he comes down saying, in the end, he's not overly concerned about the impact of inflation. And Larry Summers and perhaps others are more focused on the risks.
So we're talking about the risks. Are they symmetrical? I mean, lay out the risks of getting it wrong one way or the other. In the near term, the risks of doing too little are greater than the risks of doing too much. I also agree with the proposition that's been true since 2009, essentially. So that I think is fairly straightforward, fairly clear. The question is going to become over time, where and how are there constraints on how much is done, and where do the dangers begin to arise? And I guess I would say that if one were looking for concerns that I would focus on, I think the Treasury market is a good one to be looking at, because it brings together a lot of issues. It brings together inflation. It brings together the debt and the serviceability of the country's debt. And it also pulls in the U.S. position globally, which matters both for economic and for political reasons. Thanks to Dan Tarullo of Harvard Law. Finally, one more thought. And the winner is Hungary. There's an awful lot of talk these days about inflation, about whether it's coming, about whether it will last, about whether it will get out of control. For those of us old enough to remember the 1980s, it's not surprising that we get nervous about our money growing less and less valuable. After all, some of us actually had mortgages at over 18% interest. And the burden inflation places on savers and those on fixed incomes, and there are more and more of us, is very real. But when it comes to serious inflation, hyperinflation, the United States has never been in the same league as some others. Think about the French Revolution, when inflation reached 143%, and that is a month, not a year. Or the Weimar Republic, when it got up to 29,500% a month. And note that just about every instance of hyperinflation came tied to a war or other armed conflict.
Nearly every time inflation expectations in the UK surged, it was because of a war.
But the top prize goes to Hungary, when, in the aftermath of World War II, the pengo fell by 13.6 quadrillion% every month. Not surprisingly, Hungary decided to ditch that currency altogether and move to the forint. So even as we and the Fed keep an eagle eye on those inflation expectations and the break-evens, we can take some comfort in just how stable our currency really has been, at least so far. That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.